Hello and welcome to Williams Mullen's Benefit Companion, a podcast that helps employers navigate the complex legal challenges of managing their employee benefit plans. I'm your host, Bryden DeWitt, and today I'm pleased to be joined by Mark Purinton, the chair of the Employee Benefits and Executive Compensation Practice Group here at Williams Mullen, to discuss COVID-19 considerations for employee benefit plan sponsors. How are you doing today, Mark?
I'm well, Bryden. How are you?
Doing well. We're all working from home still. We're still in the middle of the quarantine for COVID-19, and I'm really happy that you're able to join us today on the Benefits Companion.
Thank you. I'm delighted to be here.
You and I have been very busy over the last few weeks deciphering and reading and understanding a lot of the legislation that provides relief to Americans and businesses related to COVID-19. And there's been a lot of focus on the tax credits for paid leave and employee retention tax credits and small business loan programs. But there's also relief for participants in employee benefit plans. And I was hoping you could talk a little bit about qualified defined contribution plans and some of the relief in the CARES Act that's been provided to plan participants.
Sure, I'd be happy to talk about it. First, the most important, I think, change that has been added to the CARES Act was what are called CRDs, which are coronavirus-related distributions. And these distributions are for defined contribution plans, and they would allow employees who are affected participants, and I'll explain what that is, to take distributions from their retirement accounts of up to $100,000. And when the distribution occurs, the amount that's distributed is not subject to the early withdrawal penalty, which normally would be 10% additional tax on a distribution to anyone who's not yet reached 59 and a half. The distribution, taxation of the distribution can be spread out over 3 years so that the individual doesn't have to take the full amount into income this year. And if the individual wants, they can actually repay it to a retirement plan or an individual retirement annuity or account, IRA, and they don't have to pay taxes at all. But they would have to pay the full amount back and then claim a refund on their income tax for the amount.
So really, that's like a rollover. It's the same as if it's being repaid over 3 years. But it's as if it were repaid within 60 days.
Right, exactly. It actually ties into the rollover rules in the statute. It's really favorable, but not every participant in a defined contribution plan is eligible. So basically, the affected participants, the ones that are eligible, are participants who have been diagnosed with COVID-19 or have been quarantined, or their spouse or dependents are diagnosed or quarantined, or someone has had financial impact because of COVID-19 related to a furlough, a layoff, a shutdown. Maybe the business was shut down because the owner of the business had been quarantined, or diagnosed with COVID-19. There is a throwaway sentence at the end that says, and anything else the secretary deems is appropriate. So someday in the future, we may get some additional guidance.
I think that's really important to make it clear that it's not, an open season on 401k accounts, that it's not just distributions for any purpose. It's really only for these distributions are targeted to individuals who've been impacted by COVID-19.
Right, and even though that you see this big dollar number, 100,000, the distribution doesn't need to be 100,000. The distribution could be $1,000 or $5,000, and it doesn't have to be in a single distribution. However the plan allows. It could be a monthly distribution, or it could be a series of different withdrawals based on what is affecting the individual at the time. There is a cutoff date that no distributions after December 30th, not December 31st, December 30th, 2020. So
it's limited in scope as far as time and limited as to who is eligible.
Right.
but I think this is obviously it's very helpful to employees who are suffering from COVID-19 or have adverse financial consequences from COVID-19 to be able to receive the money. But also, I think from a plan sponsor's perspective, there's always plan sponsors want the employees to participate in the plan. And this is another way for employees to receive money. It takes away a disincentive maybe that an employee may have if the employee is considering about participating in the plan, or whether they should continue to make deferrals in the plan. With these CRDs, a plan participant can feel a little comfortable that they know that if they come down with COVID-19 or they get furloughed due to COVID-19, that they can access their money.
That's right, Brighton. There's so much uncertainty about the future when this period is going to be over. So for right now, you're still employed, you're still working, you're still having payroll deductions taken out for your 401k plan. But knowing that if situations change and all of a sudden you are affected and can no longer go to work, that you might be able to get some money back. That is a real benefit for people considering their participation in the 401k plan.
Yeah. What about participants who have plan loans or would like to take a loan to cover some of these expenses?
So the CARES Act also added 2 loan-related provisions. The first one is just an enhancement on the existing loan provisions that allows, again, affected participants, the same group that we mentioned before, to take loans up to $100,000 or 100% of their vested account balance. The traditional limitation is $50,000 or, if less, 50% of their vested account balance. So the loan expansion is pretty broad. Also, the CARES Act provides that if somebody misses a loan repayment, that rather than it going into default or there being some sort of deemed distribution, the repayment can be deferred for 1 year from the date in which the first repayment is missed. And so, for example, if somebody ends up having a reduction in hours or reduced pay, or they're actually furloughed, they can stop payments on their 401k plan loans, and then the payments, rather than being defaulted, are just delayed for a year. And then when they return to work and that year is up, then they have to begin repaying the loans. The missed payments plus interest are all re-aggregated into the loan amount, and it's extended 1 more year for the loan period.
So again, another way for employees to feel comfortable that they can access their account if they need to due to the crisis.
Yeah, I think so.
What about older participants who maybe don't want money coming out of the plan with their required minimum distributions?
Well, so there is a waiver also in the CARES Act for required minimum distributions. In other words, the amount that someone who's reached 70 and a half or 72 for people beginning of this year normally would have to take a portion of their retirement account if they're no longer employed, and it would be taxable in the year it comes out. This year, though, there's a waiver on that. And so anybody who would otherwise be required to take the distribution is not required to take that distribution and not required to take it into income. So it is an opportunity not to reduce your account balance at a time when the market is down. It's an opportunity for people to avoid an additional taxable income this year.
So it sounds like there's really some helpful relief for plan participants. How about relief for plan sponsors who are funding these plans?
Well, in terms of the retirement plans, the one key relief there is that the annual minimum funding requirement for pension plans, defined benefit pension plans, which is normally due during the current plan year, has been deferred. And so if the employer wants a little more time to fund, they can delay their pension minimum funding obligation until January 1st, 2021. So that's just probably 6 months, but it does give you some more time in a pretty tight period of time in which to fund pension plan obligations.
Right. One of the things I know that you and I emphasize with clients is you have to follow the terms of the plan. And these changes are discretionary. You're not required to offer CRDs, or there is a little bit with the loans. There is some requirement there as far as the repayment default issue. But plans have to be amended for these changes. And so what are the deadlines? I mean, normally when you have a discretionary change, those amendments should be adopted before the end of the year that the change occurs. But when do these coronavirus-related changes need to be placed into the plan document?
So the CARES Act actually provides an effective date by which the amendments need to be in the plan. And so in general, the amendments will have to be adopted no later than the end of the plan year that begins on or after January 1st, 2022. That date is further extended for governmental plans to the end of 2024 plan year. So that's quite a long time. Many of these provisions will have expired long before the amendments are adopted, but as essential for the IRS's integrity about looking at the plan contract document as a contract, they need to have the provisions in there, even if it's just for historical purposes.
Right.
One thing we've tried to encourage employers is, as they've looked at the changes they're going to adopt, to provide us with information from their record keeper about how they're going to administer these provisions and any limitations they might put on it. Because 2.5 years from now, when we're trying to amend the plans, it'll be helpful to be able to look at something in writing from now that explains how they were administering it. It'll be much more difficult in 2022 to figure out what was done in the middle of a pandemic.
Right. And the same applies for the Secure Act. Remember the Secure Act?
Oh, yeah, I do remember the Secure Act. That was important, wasn't it?
I think that was a decade ago that was passed, or no, actually.
Something like that.
Yeah, it feels that way. But those Secure Act changes, the same applies to those, that we need to keep track of how you're administering the plan with respect to the Secure Act, so when it comes time to amend the plans. And so really kind of you add the CARES Act changes to the Secure Act changes, and we're going to be amending plans in 2022.
Right.
To keep track of these changes. I'd also like to mention a couple of changes for employers who sponsor group health plans. The CARES Act requires group health plans to cover diagnostic testing for COVID-19 with no cost sharing and no medical management. So that means COVID-19 diagnostic tests are provided without deductibles, co-payments, and co-insurance, and there's no medical management such as prior authorization. And also, if hopefully when we have a vaccine, the CARES Act requires group health plans to also cover the vaccine for COVID-19. The IRS recently issued guidance making it clear that if you have a high deductible health plan that enables participants to make contributions to a health savings account, that complying with the CARES Act will not cause the plan to fail to be a high deductible health plan. So these changes do not impact the status of your plan as a high deductible health plan. And from a practical standpoint for plan sponsors, these changes will be implemented by insurance carriers. And if you have a self-funded plan, the third-party administrator in their summaries of benefits will be updating the documents and complying in operation. But it's important to make sure that those things do happen, that employees are not having difficulty with having their diagnostic procedures for COVID-19 covered, and also that they're receiving the vaccine once that becomes available, hopefully in the near future. The CARES Act also changed the rules regarding flexible spending arrangements, that now over-the-counter drugs are back, that an over-the-counter drug can be reimbursed from a flexible spending arrangement.
And that also includes reimbursements from HSAs.
Yes, that's right. Well, Mark, thank you very much for joining us on the Benefits Companion. That'll wrap up our discussion for today. If you have any questions or suggestions for future episodes, please contact me. You can also visit our employee benefits page at williamsmullen.com/employee benefits. There you can find out more about our team as well as past episodes of this podcast and legal alerts. Be sure to subscribe to this podcast to be notified when our next episode posts. Thanks for listening.